4, 3, 2, 1. Ladies and gentlemen, thank you very much for coming and joining us online today. I don't say tonight because it's still afternoon in Geneva. It is early morning in Canada, and I believe in your place is a good weather and right time. Thank you very much for finding time and possibility to join us. And today I'm happy to welcome, I always say, one and only Igor Zaks, because to me he is one of the smartest and most detailed specialists in the area of credit management. Please join me welcoming Igor online tonight. Igor, you are welcome.
Thank you, Andriy. And it's my pleasure to join you on this webcast.
Okay. So Igor, as you may know, as everyone, as it was announced, today we have credit chat specifically dedicated to credit policy. Well, altogether, it is one of the most unclear part of credit management because everyone, every company, every organization treats it as they believe is correct, and there is nothing wrong in this. To my humble opinion, every company is to adopt its own credit policy which serves the purposes of organization. However, at the same time, adoption of credit policy may also bring more harm than help, just because the credit policy is either organized in the wrong way or especially or could be directed in the wrong way and actually bring in more negative results than positive ones. So today we will try to define what is the credit policy. We will briefly touch what we have to consider as a credit policy, and then we will speak about examples of credit policy and results it may bring. So Igor, first question would be to you, and then I will add maybe my 2 cents into this discussion. I usually suggest, and a couple of times at least when I was drafting a credit policy, I was insisting on splitting policy and procedures. Maybe something else. So what do you think in general, what is the main purpose and how do you see it? We might see it differently. What do you see as a credit policy? How it looks like? What are the important components? Like, how would you define the credit policy?
So maybe go back one step and let's look what purposes the policy should serve, and then obviously what it should contain. And I will be a little bit controversial because to me, the reason credit policy exists is to protect communication. It's basically to have an ability of a credit manager to effectively go beyond this policy issue when they need to defend their decision.
May I interrupt for a sec? When you say the purpose of credit policy is to protect communication,
yeah,
do I understand correctly? Sorry, because I believe this is very important for
absolutely.
me, for enlargement of my knowledge, and I always will and I will be always trying to reach your level. But when you say it is to protect communication, you mean that credit managers supposed to deal with issues outside of his or her authority. So does that mean that the credit policy gives a credit manager a kind of framework how it is possible to affect other functions within the organization.
Yeah, because like there is a different politics inside of organizations. You have many organizations when, for example, sales will have a lot of clout in organization
Yes.
and can put pressure on credit. Now, I think credit needs to be flexible. I think credit needs to be constructive. I think credit needs to look for solutions. But at the same time, they cannot be seen as a weak part that you can just go and say what to do. And part of why the credit policy is there and why it is typically approved at the highest level in organization is to provide a framework for this. So to basically say, guys, this is our policy. You cannot force me to make a decision. There is an authority matrix, there is a procedure, there are things like it. So we can talk constructively at that start of communication. How do we do it? Provided this framework. You just cannot go and tell me, you know what, I want this customer to have, this limit, these terms, and,
Yes.
I will go to the president and I will say, that's what you are going to do, get lost. And that's one of the reasons the credit policy exists, is to provide a sort of umbrella, provide this protection for a credit function to start a constructive dialogue as different from, say, just a pure power play. And that's one of the reasons that a lot of people overlook. But this is, to me, one of the core parts. Because if it will not be so, and if you will live in an ideal world where everybody works as a team, one can potentially argue, and we can say why this will not be 100% true, but partially will be true, that you don't really need a policy. You need to look at the risk-reward side, you need to all come together, and you need to find a solution, and that's, a discussion of, a team working together. In reality, you always need to structure it a little bit to actually create a situation that's going this way, and that's one of the reasons policy exists.
So I got a feeling from your words that the bigger the company, the more it needs a credit policy, mainly as organization.
Absolutely. Just provide a communication structure between the departments, is telling what are the expectations, like on a base case scenario.
Yeah.
What is the escalation path, like authority matrix, and it creates this framework within which the decisions are. Now, and I agree with you about difference between policy and procedure, because you have a procedure saying, okay, when we approve the credit, we need to ask for X, Y, Z, and, all the stuff like it. And procedures have a different purpose than the policy. And one of the purposes of procedures is to ensure some degree of consistency. Because if you do not have any type of framework on the procedures, your performance may be very different in time. So you have some time when you have a lot of losses, sometimes you have a little bit of losses, and that's making it difficult from a planning standpoint, because you need to expect, how much you would expect, of all the different parameters. And if you don't have some degree of procedure, you don't have some degree of consistency, then it may vary significantly, and that makes it very difficult to manage organization. And there is a third purpose of the policy, and that's external communication. And external communication have two components. One component is communication with customers, because the same thing, it's facilitated communication. It's saying, that's the standard you should expect, this is the process you should expect. If you need something different from it, there is a procedure and a path, how it's agreed. Just don't go to a poor guy who is talking to you, ask him, give it to me right now. Because there is a process for it that is described, and you need to understand that you need to have appropriate discussion, again, framing a policy. And lastly, if you deal with financial institutions, you deal with a credit insurer, you deal with a bank, you have, a back lending structure, whatever. It's also a tool of communication with them, because they will say, oh, we agree to, provide you certain facilities subject to your adherence with your credit policy that we studied, and therefore we have also some comfort that your behavior is predictable. That's, to me, the parts of it that I would think are important.
I mean, with credit insurance is, let's say, one of the clearest part, because if the company doesn't follow its own credit policy, then the position of credit insurer would be absolutely different. So
Exactly. And if you use a discretionary credit limit, the procedure that insurer will say you need to provide us a credit policy. You can do your own limits within your discretionary limit. However, when you make a claim, you need to back it with a paperwork
absolutely,
that is showing you comply with your own policy. And that's actually becoming a completely separate and very important question. How do you write your credit policy if you are going to use credit insurance? Because I saw people who write a credit policy, never follow this credit policy,
then
that
they go
sort
for
of
insurance,
might be
then they got
okay,
stuck.
but they got insurance and they suddenly find that they have one policy on paper and one practice in
Yes,
reality. And by the way, the practice may be perfectly fine and the policy may be perfectly fine, just not consistent. And because the policy was written 20 years ago. And that can cause a lot of trouble.
well, yeah, but this is exactly what we will be talking about. But I tend to think that the reality, I mean, one of the best example of the issues with the credit policy is when the processes and the way the business is done within the company goes one way and the policy is directed in another. This is but coming back to the policy, um, I got kind of mathematical explanation of what is policy, because to me, I believe somewhere in the core of credit management stands really a decision making.
Yeah.
So the way the company takes decision, and then all together, I mean, not in contradiction with what you just said. Um, Policy is supposed to cover the majority of operations. And to me, policy itself supposed to set kind of general rule, general direction, very similar, by the way, to British legislation, which gives really a framework again where and how we take decisions, and then obviously authority level supposed to support it, because um, it's not really appropriate when the credit manager with the or credit controller is taking decision for $100 million credit line without having any framework, because sometimes we got exceptions, and the way we review it. And to me, I just enlarging our framework for today, um, just maybe just giving another color to what you said, like to your example, when the company has one policy and operates differently. The problem is when the company has credit policy and actually adheres to it, but this credit policy is not corresponding with company strategy, and this
It's
is actually the story.
it's an interesting point, and I like your point about the English law. I mean, there is no such thing as British law. There is English law, Scottish law, and things like it. So there,
Yes, yeah, I was getting
but I mean,
that. Yeah.
but again, if you look at the legal systems in the world, there are two approaches. There is a civil law and there is a common law. So the civil law on which, for example, Switzerland operate, or a lot of European countries, was
Let's
based on
call it.
Napoleonic Code.
Yes, that's
Basically,
what I'm trying to say. Codified
you need
legislation,
you
which is
need to
called
codify.
Continental One.
You need to go and you need to write all the different rules, and this is the function of the parliament, and then judge only interpret whether the rules were followed. The English law was very different. The English law was a precedent driven. Andriy, you are off camera.
Yeah. I'm just replying. So
Okay.
I'm listening to you.
So the English law was based on a precedent. It doesn't have a constitution. It doesn't have set of rules. It's a precedent. So every time you come to a situation, the judge make a determination, and this become a precedent in any new case that is looking like it. And taking the analogy, you can run the policy in both of these ways. You can either try to codify everything, or every time you come across a new situation that require escalation and that require senior involvement, you make it as a precedent and you follow it going forward. And in this case, this is why in many cases, English law is far superior in commercial disputes because it's constantly updated. It's by definition. Every time you come across situation, you record the way you dealt with the situation, and this is becoming part of the policy. So to me, you can run it both ways. I'm a big fan of common law, English law, or Canadian, US, whatever, follows a common law
In
country.
Canada, you got also kind of English system, or
Yeah. It is similar. I mean, they obviously divorced it a while ago in terms of precedents and whatever, but the basis is the same, the concept is the same, but obviously some laws are different because you have precedents, being set in different places, and they may not be the same. But in principle, it's very similar. US is even more diverse, obviously, but again, it's the same principle. Unlike, say, Germany or France.
Well, the thing is, you see, what I'm trying to say, and using this analogy of English law. So I hope I did that mistake only once, but I might repeat. The thing is, to the way it is known, in a way it is known to me that English law sets, I mean, they got like codified legislation, like bills, like everything. You've got it in Canada as well, but it has very, very, very wide framework where judges, or actually, let's call them operators of law, has the right to define the best way to take what is called tactical decisions, and best way to do, like, smaller level, smaller scale decisions which are more important.
Oh, they're very big scale. If you go for a Supreme Court rule and the thing like it, they're very big decisions, because and this is the basis of democracy, by the way, in Anglo-Saxon world, that you have courts effectively keeping quasi-legislative power, and they're counterbalancing the parliament and the president, if you have a president, say, in US and things like it. And you saw like a lot of decisions by, say, various US presidents were challenged by court. And this is important. So the decisions are, I mean, effectively what you get another part of legislation activity going there. And the reason being that in this system, and again, it's have a very good analogy and it's very relevant to the way you do credit policy, that you are saying you cannot get people once in 10 years in a big room, provide them, a whole bunch of things, and they will write a perfect legislation. In the common law system, we don't believe this can be done. So what needs to be done then, whenever we get a specific situation, we're not only making a tactical decision, as you mentioned, that's what lower courts are doing, but if it is an important issue, we then go, we consider it, and we look how to do it going forward. And if we look in a credit policy equivalent, like, look, COVID, for example, we've never been through this type of situation. So anybody who wrote a credit policy 5 years ago can have no foresight that we will get a situation when, for example, personal contact becoming difficult. And if your policy is saying you need to meet a customer face to face and you need to speak with them for an hour before approving a credit limit, I'd make a simple example.
Yeah.
You suddenly find there is no such thing that can be done. So how it will work in an English law sort of system, you are getting the situation and you are going to a judge that in this case will be, I don't know, CFO, and you are saying, we have this situation, we cannot comply with this requirement. We need to decide, given changing circumstances, what in this factual base will be the way to decide. And he will say, oh, in this case, you make a Zoom call. I'm, making it like a very, very simplified example because that's the best you can do. And then it's becoming part of the policy. So right in the policy, and you are saying, temporarily, when the meetings are not possible, we will apply a Zoom call as an alternative to meeting, and that's becoming part of the policy.
Okay, so you've taken exactly the example actually I wanted. Or like customer call on the third day of overdue or something like that. So things like meeting the customer in person for say whatever reason is, or like it's quite a technical thing whether or not. So let me ask you finally direct question, like without giving you a chance to answer, like it all depends. No, things like calling customer or sending customer an ordinary email, something, is it a part of policy or procedure? Because here we feel the difference. I believe this is the procedure. And procedure, when we say procedure, I do believe that even if it is part of the credit policy, this English approach or common law approach is much more better because it ensures, if I pronounce that correctly, Ausfachtaktik, from even Prussian military doctrine. So it was very, very disciplined, but they were using Ausfachtaktik, which technically means free tactics. So the one who is doing the job supposed to be able to decide how to do it better. And the question again, do we have policy and procedure? Should we have really strict difference between them? And to my understanding, this is part things like calling or not calling customer, meeting or not meeting with the customer, is actually part of the procedure, not the policy. Policy is supposed to give a general direction.
Okay. No, I agree with this part. However, there is one part of this that should be policy, not procedure. And policy is a minimum standard.
Yes.
Okay. If you like I'm making like a simple case. You need to escalate when the customer gets a certain amount of overdue. You need to do this and this. That's a minimum. Should you wait for this period and only do it then? No, and it depends on the circumstances. What is your optimal cost? But you cannot sit on a debt for 90 days doing nothing because you think you are so smart to decide to do nothing. Okay, that cannot be the case. So it should be always a type of a checkpoint determined in a policy that require a minimum standard that is needed. Whether you need to do this or you want to call 10 days before it's due and check everything, that is a procedure. This is the best practices, this is procedure, this is whatever the thing. So you are saying what will be the right one. But if, for example, and that's what I saw with people who have procedure but don't have a policy, because you go there and you're finding tons of that stuff sitting in
like this
high overdue bucket, and you're asking, what have you done about this? And you'll find that they done nothing, because some very, very smart people thought it was all fine. The sales guy gets some assurances that everything will be good and things like it. What you don't have a checkpoint. You don't have something when it is saying, you know what, right now, there should be this happen. If this does not happen, that needs to be escalated to the CEO level. And this is a matter because that's something that can affect our company. And if you don't do this, you then go, I'm going back to what I started about internal politics and about the need of policy as opposed to procedure to protect you against the impact of the policy. Because then in your communication, you are saying, look, dear sales guy, right now you are talking to me, but in 30 days, we are both going in front of the CFO.
Yeah,
and that will be escalated, and we need to actually explain our actions. And that's a policy requirement. I can do nothing about it. Okay, that's what will happen. Do you want to wait until it will happen? And then, one of us or both of us can be in trouble. Or you want to sit together, find the best course of action, and resolve the problem before the policy saying you have no choice but. And that's so the policy is like a safety net. The procedure is like a guide. Two different things.
Again, why I'm so insistent on that difference? Because if we got policy looking more as a procedure, then the question, what company needs more? I won't be saying this famous joke from your hometown. Do you want to go or do you want the sign? But the question is, on the other side, with the procedure, and procedure replacing the policy by itself was because somebody believes the procedure is more important than the real policy. So what do we want from people? We want people to follow procedure, or we want people to get results. I believe results are predominant.
However, what you need to have an agreed ways how you measure the results. Because if you don't measure the result, then again,
no, we are very close. We are very close. We are much more close than somebody may think, because we agree what results we achieve, then how we achieve them, and then how to split it by tasks. This is already procedure, because first two is policy.
And the other thing that again is probably important for many people on the call, because there are jobs on the line. If you are performing standard tasks required by procedures, you should not have your job, because there is a thing named robotic process automation. If you need to make an auto reminder at a particular time,
yes,
why on earth do you need to have a person to do it? Like, you have a lot of software solutions that will provide this, and that will be very easy. And we are not saying about AI or all this very high-tech stuff. It's a very simple, very basic stuff. The invoice is going to 30 days. There is a predetermined form of a letter, and it's going to a customer. And that's cheap and highly efficient. You don't need to have a department to do it. If you want to assess the credit by looking at a score provided by, one of the agencies, and you are saying if the score is above this, you grant credit. If it's below this, you don't grant credit. You don't need a credit manager. Okay, so you can do it. And by the way, I will argue there are some cases when maybe you even should do it. But in majority of the business, the majority of the case, you cannot automate it like this. So you don't try to make people robots from people, because robots do robots' job better. People need to do something that require a degree of intelligence.
Let's move forward. And ladies and gentlemen, I believe you got excited about automation part, and I promise I will get Igor on another discussion, maybe in wider scale, because we've got lots to speak about automation. But again, even if we do such a policy, like simple one in transactional business, what if we have to review it? What if situation on the market would change? So I believe.
And again, one thing I say about policy as umbrella, as a defense, but what you don't really need to do is to get people speaking like that was on Nuremberg process, when they were saying, "Oh, what do I have to do? I just follow the orders."
Yes.
And what we don't want to do, we don't want to get in a situation when people will say, what is your question to me? I follow the procedure.
That's what
you want people to make a responsible decisions, to take responsibility for their decisions, and to be accountable.
So people supposed to think we should not. I mean, we still rely. I absolutely agree with you that if we want to have people following procedure, we better do automation or computers. Okay. Okay. Let's us make a refreshment and make 2 minutes. Let's dedicate 2 minutes to the question. Hi, what if companies don't provide required details, which is mandatory for credit for approval, but at the same time company need business, and if we don't provide them credit, another party will gain that business? Well, if you don't mind, Igor, I will answer myself quite quickly. So, welcome to commercial reality. Uh, this is what is called inclusive credit management, where you use credit to attract customers, and okay, circumstances are as they are, market as it is, and that's actually the art of taking decisions. I believe so.
And I will add here that you can get comfortable with a credit decision in multiple ways. And to me, having a couple of financial ratios is by far not the only way, and by far not the best way in doing it. There is a million of cases when I don't really need to look at financials to understand this is a low risk.
Yes.
There are also cases when I will have perfect financials, I would not touch it with a stick. So you really need to look at holistically, you look at a lot of factors. And if you lack some of them, you need to look whether there are other things that provide you comfort. That, and by the way, I'm not saying necessarily, I definitely dealt with a company that would never share their financials, but at the same time, will have no hesitation whatsoever to give them credit.
Well, I will
And I will have a bulletproof argument. Why would I be able to do it? And they will not go into any type of trouble. At the same time, I saw companies when you have very good financials, audited, whatever, you have a feeling the books are cooked. You have a feeling that this whole business is unsustainable. There is a massive operational risk. And the fact they have XYZ equity and the XYZ profitability and the positive cash flow and all the crap like this would not really give you any type of comfort. So you really need to look, and by the way, I'm not saying you shouldn't look at financials. You should if you have them, and you should take them very diligently. But I'm just saying that's not the whole picture.
Afan, I just add a couple of words to that. Look, credit assessment is not actually the only part of credit granting. You can assess credit and then, credit assessment is not a credit decision itself. You better, within your company, you better split credit decision making and credit risk assessment. Okay, we promised to give several examples of wrong credit policies. So yeah, Afan, if you still have questions, don't hesitate to ask me or Igor publicly. Um, well, I would provide my favorite example. It's quite a simple one. But again, this is still about credit policy, and why we call it policy, and why I always insist that it should be called, because policy is a policy maker. It's kind of strategic decisions, so the way we take decision, who's supposed to take decision, and so on and so forth. So best example, I always give it in my courses, this example: two companies merged. It's a distributor, two distributors on one of the markets in European country. It's everything under NDA. I cannot tell you more. So two companies merged, two distributors of product, and then they gained actually 60% of 60% market share, really dominant position. Surprisingly, their sales director said, "Why don't we save some money and simply stop granting credit to our customers?" Well, if sales director proposes that, CFO is the one who will follow. Just like, it's music for the ears of CFO to have down payments or to have cash in advance. It was said and it was done, and I think in 3 or 4 weeks, company lost its market share from 60% to 20%, just because customers in the lower level in trade chain were not prepared not prepared to pay cash in advance, and their custom and other, these smaller distributors, there were, I think, 2 or 3 of them, simply continued to grant credit, and they received bigger market share, like doing really nothing, absolutely nothing, no marketing, no efforts. People just started to come to them. So, well, one thing I have to say, this company had really, perfect receivables. The problem was like
If there was prepayment, they would not have receivables, by the way.
no, they
They
had
would be
some
on their cash.
receivables, I think, because they still got maybe they had like yeah they had part of suppliers whom they were paying in advance, therefore they had receivables also. But the thing is, to me, I still believe that this is really a credit policy issue. It's not about, it is not about business, it is not about something. And when I explain, or when asked to explain what's wrong with that, I said, companies simply overestimated its capacity, its bargain capacity, in a very, very dramatic way, I would say. Because the problem uh, they didn't look deep into details, into the situation of their customers, into the potential impact on sales of this credit policy. And furthermore, just last word maybe about this policy, I believe same results could be brought by a credit policy which is built in that reluctant, restrictive way, like controlling sales, like protecting companies' assets from customers who are trying to abuse it, and so on and so forth. And like uh, one of the business owners once told me that I can make my receivables perfect tomorrow. The problem how much sales I will lose.
Shall I take a minute to answer the question that Paula asked it, because it seems
Yes,
to be
please.
referred to
Yeah.
what it was. And, his question was basically, how do you justify if you grant with companies without financials? Now, and how you do it in a policy. First, the policy should never state that the only way you can grant credit is when you have financials. It should state that it can be go at a certain level of authority if you have them, and it needs to be escalated to a different level of authority with a full background and a full details related to this case if you need to make a decision without it. It's basically all the credit policy is supposed to be doing is to determine what are the circumstances people can make decisions. Because if you are saying that board of the company together with the CEO cannot go and cannot decide anything that's not in a policy, you shouldn't have this policy, because then it means they just need to rewrite it. Okay, you always have a level at which you can make a decision. Now, what can be the basis? Also, the policy should state that a certain level do not have authority to do it without financials, and that's absolutely right, because you would not expect a junior person, say a credit analyst, to be able to make a decision in complex circumstances. That's not that's above their pay grade. It means somebody else needs to get involved and need to look at this. If you look, what do you do? I mean, I'll give you an example. We once were dealing with a company that was providing an absolutely critical part to a very, very large customer, and we were the core supplier. So basically, if these guys go bust, people will get losses. Now, if I put it as scope, our exposure to them was about $1 million, and the losses that will happen if they collapse or if we stop supplying them for their main customer was over $1 billion. And the view I took is this company will overpay. I don't care about their financials, because in case they go bust, the damage to their customer who can buy them at a flip of a second, who can pay us directly at a flip of a second, will be 1,000 times more than total exposure to us. So the view I took there, looking at all the contracts and looking at all the circumstances, that my likelihood that somebody would not find a solution that only require paying me $1 million to avoid $1 billion loss is extremely low, much lower than any type of a model you can do based on financials. I'm just, picking an example. But this is a decision you do when you understand the industry, you understand contractual relationship, you understand various things. If you just look, if you only trade at looking at, debt to equity ratio, I mean, you then obviously would not make this type of assessment.
Well, you can always, by the way, in addition to that, because I just read the Paulo's question, On the other side, you can always find, a way to ask them, or maybe you just repeat your question a couple of times, and sometimes doors are opening.
Absolutely, but I'm just saying case when I don't even need to ask, because generally I'm disinterested in looking at this, in this particular case. So
Yes.
if I need it, then I will find the way to get it. And
Yep.
one of the ways to get it, and for example, a typical conflict that credit people have in a distribution channel is people don't want the sales guys in the supplier to know their margins, because that can affect the commercial relation. So what you need to do, you really need to establish a Chinese wall, and you need the customer to believe that information shared with credit department would not be shared with sales.
Well, NDA institution for that exists and works pretty well. But again,
Um,
it's just a matter of trust.
No, I mean that's the type of sale of things you have. So, and I get it, like in many cases, that people generally would not share it with my predecessor because they will believe it will be leaked,
Yeah.
and they will be very happy to share with me because they don't believe I will do it, because in their view I was a person of high integrity they can trust, and the other person was not. I mean, just as simple as this. That's what you learn in business, in any role, including credit.
Sure. Any example from of credit policy from your side?
Absolutely, and I will show example slightly opposite to yours.
Okay.
And the example was, I was dealing with a private equity company in a bit of distress. And they actually were reasonably open in granting credit. They were growing their sales quite successfully.
Mm-hmm.
However, they were basically looking, they get some type of assessment of the credit of the customer. So they didn't have a lot of bad debt. What they get a lot of slow paying customers.
So, I mean, the main issue was overdue.
The main issue was overdue, and basically there was a limit how much collection effort can improve. Okay, just where the customers that, by the nature of the way they operate, were slow paying customers.
Mm-hmm.
And what happened? Company is in a little bit of distress. So these guys are saving money whenever they can. So they were in a high tech sort of business that require a lot of R&D. They were cutting spend on R&D, not keeping their product up to date enough. They were cutting expenses on the marketing. They were cutting expenses on a lot of things that were critical for getting the business. At the same time, they get a slow paying customer. So the way we look there, and we say, guys, let's just look simple. Where's the best use of the money? If we will move 10% of the customers that perform badly in this respect on a prepayment, we will lose probably 2/3 of them, as Andriy showed in his example. But look, if we lose 2/3 of it, we lose 6% of the business. And if we spend money enough on keeping our products, services, marketing, things like it, we'll increase it by 100%. So I was perfectly willing to do exactly opposite to Andrey's example, i.e., to say with all these customers that are a slow paying customers, and we have a very sophisticated way of measuring, whom do we apply it to. We'll ask them to do prepayments. We'll do exactly opposite to what was there. And if we do this and we reallocate the money to other area, then we'll gain much more than we will lose. And that's happened to be the best decision they made. So what was the wrong decision in Andrey's example, was the right decision in my example, because for this particular subsegment of customers, getting this liberal with the payments was not the right way in the circumstances of this company. It might be when the company was in a better financial position and was able to have a relatively low cost fund because they were profitable customers. However, return on capital, given the circumstances, capital was very expensive for the company.
Mm-hmm.
Have alternative uses, was not good. And it was the wrong decision to grant credit to this subsegment. So that's why I'm saying you really need to make sure your policy matches the corporate situation. And the situation of this company was different, so the solution was different.
May I ask you, but did you measure somehow, or maybe get in touch with understanding about the demand of this company's products?
Oh, absolutely. but then you also need to look to which extent the credit affects the demand. Because I've seen
Yes.
areas when generally you ask for prepayment, you get it without any shift in demand. People don't care.
So,
And I've seen situations when actually you sell on credit, and credit is more important part than I'll give you an example.
no.
We were
Let's keep with your case, because that's extremely important in terms of credit policy. I'm so sorry for interrupting, but this really important, and
yeah
it touches the very sensitive string of my heart. Uh, you measured, or somehow you understood, that the demand for the product of the service of this company was quite high, and they were granting credit just to grant credit.
no, I was saying a different thing. I was saying that out of various levers to increase demand,
Yeah.
credit was not the most efficient. So if you spend more on marketing, for example, in their case, or you
Okay.
improve the customer service, you get higher increase in demand than by offering too much
Okay, so
credit.
they were trying to do marketing job with credit management, and
I mean, look, I'm taking holistic view. I don't believe credit is a sacred cow. Credit
oh
is a service that you offer with a product.
yes,
It's the same thing as you can offer a warranty, for example, extended warranty, and you can spend money providing extended warranty, or you can spend money, hiring more salespeople. So you have multiple tools that affect the demand. Now you can change the price. You can offer at a lower price. And then if you look at economics, for example, with price, there is a thing named price elasticity. You need to look how much the demand will change if you increase or decrease the price by X. The same thing applied to credit. And what you need to look from a company, from a holistic company point of view, is
exactly.
whether credit is more efficient or less efficient tool than other tools at your disposal using the same money. I am okay having bad debt. I am okay having a slow paying customer if the return I am getting on this is higher than
Yes.
alternative uses of money I can have in a company. And that's what most of the people miss, because they look at credit as a type of isolation. Like, okay, we get more terms, we get better sales.
Yeah.
Okay, that's true. However, and that's absolutely true. I give another 30-day credit, my sales going up by 10%. That's great. But my view is different. I spend $1 million in increasing my AR to accommodate these terms. If I will spend $1 million doing, for example, an extended warranty, or for example, if I spend $1 million on marketing, would I get a better result or worse result? And this better result, I should be very tight with the credit terms, and maybe the guys are right. And I know the business when I will say people don't even bother, do prepayment, because at the end of the day, you will gain, I don't know, another 20% of customers extended credit to 90 days, and you will lose 80% of customers by not providing certain things. You use this money. Again, it's all depends. You always need to compare just one tool,
Yeah.
and vice versa. Showing an example, a good example. We once get a customer, and we were competing with another supplier on this. And also, there were a number of suppliers that were not directly competing with us,
Yeah.
but were complementary to what we were doing. We managed to find a financial solution when we extend a lot of credit. Not only, and we done it with a very good risk mitigation for this.
Yeah.
Not only we won the tender and we dismiss the competitor, all the supplementary stuff they asked whether we can buy, and they were happy to pay a hefty margin for us because we will put it as a part of overall financing. So when we look at this and we look at the return we get on what we financed, it was astronomical because we won the business and we also won a free money more or less for basically reselling the stuff that they already get contracts, everything. They just say, oh, on paper, just buy it from us, include it in your package, ship with it, provide the finance.
So
And the finance in this case was that simple. It was, a letter of credit with a draft discount, and so there was no credit risk on our side. It was unconditional obligation to pay by a major bank, purchased by another bank at a discount. Nothing of risk to us. But because our competitor was stupid enough not to do it, they lost the business, plus we gain additional business. So that's always the thing. You always need to look at relative value.
yeah, so what I mean, partially answering the question from Paolo, it's a question, I from time to time I present credit as what is called like money in relationship with an employee. It's like hygiene factor. You just need to provide right credit, similarly to famous phrase, give credit when credit is due. So you just need to provide exactly the right credit to a counterpart, not more, not less, because if you
Absolutely.
overdo, you just waste your resources. If you underdo, you are cutting your sales, and sales itself, just I will finish because that's kind of important concept. Sales are not depend only on credit. We can easily prove, Igor knows this, my favorite joke, that credit is not selling. Credit is important factor to happen to actually overcome customers cash shortage or whatever way it is, but credit is not selling. Very simple example. If you would like to buy a Ferrari, you won't buy, I don't know, Fiat 500 just because there is very good credit on it. Coming with it. If somebody does not want this product or product in this way or with these terms other than credit will not be a decisive factor. Just like
Uh,
this.
but, but I would also say, of course, there is a very important relationship between credit and sales. There is also a very important relationship between credit and customer behavior. Because if you offer too little credit, you just need to think what your customer going to do. And very often people who are offering short terms believe they're doing it to reduce the risk. They're increasing the risk because what's going to happen? If you know your customer is paid in 120 days and you ask them to pay in 30, how are they going to finance this 90-day gap?
Exactly.
And I'll tell you what they're going to do. They're going to go to their bank. They will secure absolutely every asset and they will borrow heavily against it. If they default to your bank, your recovery will be zero because they will take everything. So
yes.
if you would be matching, if you will be within, their own working capital cycle, they will not get leverage. And they will stay, like I'm saying about people who are mainly working with you. They will take a responsible credit risk policy and you will be paid. Here, every time they effectively pay you in your 30 days, that means they went to their bank, they pledged everything they have, and the best of luck for you to recover if things go wrong. So very often, and I just pick a simple example. Very often, when you think about the terms, the impact of this on risk is uncertain. The impact of this on sales, as Andriy mentioned, is uncertain. So you really need to look at this within a framework and understand, what impacts you have of your decision, and then do your decisions to match this framework.
Well, you mentioned, and now you just touched another sensitive stream of my professional heart here. So, do you consider so should we consider lost opportunity as a bad debt or even worse risk or worse outcome of our decision? Because to me, lost customer is even worse than the bad debt. If we lose a customer, especially if we lose an important customer, so we have to replace them with another one, so we have to spend money to attract the new customer, then we need to establish relations, then we will have issues.
Okay, let me put it there. To me, somebody who is not paying you is not a customer. You're doing a charitable activity. And I'm very happy to give something to somebody on a charitable reason, but the customer is not this person. No, customer, I want to get something to be paid for it.
I didn't mean this. I didn't mean this. But what if we simply thinking to grant credit for to loan and customer goes to competitors? I don't
No. But what I'm saying is that's not an excuse to give something that is on a risk-based basis, not profitable. Now, if I'm making 10% margin, I have 50% chance of customer going bust. I'm not going to do it full stop. And if the customer get lost, that's their problem. I'm not concerned about it because that's not profitable for me. If I though make my bad debt to zero by losing a customer on which I'm making 1%, sorry, 10% margin in this example, and my expected loss is 0.1%, I'm stupid because I could invest 0.1% in bad debt to get 10% of margin. And that will be a much better deal. So to me, I don't believe there is a magic there. And I'm not saying, do you need to lose customers from time to time? Yes, there are customers you want to lose. Do you want to retain customers in some cases, despite the fact you have, unusual degree of risk? Yes, but it's a rational decision. You look at this and you're looking at the terms of a deal. Would you invest money in this deal? Would you, it's the same as you do, as I show example with R&D or with, service or with anything else. If it is worth investing money, it's meeting my company objectives for investing money, I'm good. And if it's not, then I'm not good.
No, absolutely. So I'm just saying about that, because okay, we can make it even more simple, improvement of accounts receivable portfolio at cost of sales reduction is one of the most stupid ways we can follow, again, provided that we are still making profit. Igor, should we consider another case, or we will go to Q&A?
Let's go to Q&A. I think.
Yeah, ladies and gentlemen, we decided not to not to make you sleep in with our stories of couple of gray-haired, bald, nearly bald former boys. So if you please come up with your questions, because
can I pick the question though that's already posted by Daniel?
I just wanted to sound it. That's the point. It's crucial knowing our customer payment behavior before commercial relation. Well, so you answer first, or do you want?
I mean, okay. If you know the customer payment behavior, it's obviously an important part of any commercial decision, because I want to understand what the reality going to look when I make a decision. With a new customer, often you don't know. So when you don't know, you need to make some assumptions about what this behavior likely to be. And then you use all available information to make this, and your assumption may be wrong, you're never perfect, but you try to do your best job to estimate it before making a decision.
Well, my position would be a little bit more complicated, because I am too strict about use of the payment behavior, especially if you say, because there is I think there are two types of payment behavior, two types of understanding of payment behavior. One of them is actually payment history, another one is payment attitude. So with the payment history, if we have detailed one with very clear understanding what is detailed, because very often overdue, which you may see in the third-party sources, usually concerned with disputes with different things. And I was illustrating that, like, I don't name anybody, but
and that's, by the way, number one thing you do in analyzing the credit data. You distinguish between credit and performance, because that's the most important thing. Like when you look at the write-offs, you look at the write-offs related to dispute, nothing to do with the credit. You look at delays related to a logistics issue when the customer shouldn't yet pay, and you just Because very often what you see, and that's a big thing you see in payment behavior, you issue an invoice because your standard accounting system is set up to issue invoice at, I don't know, 45 days.
Yes.
Your contract is saying that it should not be earlier than the goods are delivered. And your goods are stuck in a transit. You are then shown there is an overdue. People pay me in 60 days, not 45. But you know what? They didn't owe anything to you at all.
Well, that's again, this will be interesting point for our next discussion because you know it's already automation issues, so we're supposed to take care of that. But again, so when we say about the payment behavior, you know, somebody could say the customer is not paying their suppliers, and then you have a look at the, you know, kind of payment history, you know, like overdue from the third party, and then you see like customer with the tens of billions of dollars turnover has 10,000 overdue. I'm sorry, does it look really serious? So again, you know, and if again, but by contrast to that, why I say payment attitude, when you take trade references, for instance, and you got like several references who are saying these guys are not paying just because they believe they should not pay on time, that's already different story. So this is already behavioristic, and this is already an attitude, and in this case you better think twice before engaging with such a customer. Or
and then there is a third aspect that I think is very, very important in credit, and this is the nature of transaction. Because, for example, you know, I have customers who were having two types of business. They were doing business related to end user projects, when they already know exactly when I supply them, they already get somebody who is going to pay and who is going to them, and they will have it. And the same customer can buy for inventory. And the difference is inventory, they may not be able to sell quickly. They only make a guess we will sell quickly.
Yeah.
And that means that if, for example, I have a perfect performance with them when they were doing for end user orders, because end users were good quality companies, they pay on time and things like it.
Yeah.
With inventory, you get stuck. And I recall a particular case during the dot-com crisis, you know, just can think how old I am, when a very famous electronics manufacturer, not the one I used to work for at the time, one of the other, when demand basically disappeared for a lot of their stuff during dot-com crisis, they thought, oh, it's our channel not doing a good job, so they offered a lot of incentives, stuck the channel with billions of stuff. And then what happened? The channel was not able to sell anything. And that equipment going obsolete very, very quickly. Cost them a lot of money. So what you really need to think, and that's the most important thing in both the credit decision on a risk and on the payment behavior. You need to understand the nature of transaction. Because, yeah, payment history is valid and important if you're looking broader at the same nature. But if people start doing something different, you just need to understand whether their plan makes sense. You know, maybe you would expect them to have a lot of problem getting liquidity. They don't have access to sufficient source of liquidity. So you then can be sure that at best you will get payment very late, and at worst you will not get it at all.
Well, again, you might provide them with the longer payment terms if risk permits, and if
no, but again, you do it if you know it's a question of time, not question of solvency.
Absolutely.
And you need to understand, because as I say, buying for inventory in a very unpredictable market, it's not. It can be a question of time. It can also be a question of solvency. And if you give them a lot of long terms to build higher inventory, and you're not sure they can sell even smaller, you may end up in a situation when they go bust. So you really need to think in a balance. And you know, I just pick an example. Or I saw people who won a massive contract, but they have no experience in doing it. And you're then thinking, am I going to take this massive risk for people who can basically fail on the terms, not being paid by the end customers, and have no money to pay me? Am I going to go to this situation? So you really need to think beyond the numbers, whether it's the credit, financials, or the history. You need to understand what the nature of the business. You need to know your customer in a good sense, like not in terms of ticking a couple boxes. Understand what business they are. Have a beer with their owners. Like you really need to
Not only
understand what
this,
people are
but
doing.
what I try to say is the best advice in terms of credit management. I believe, Igor, you will agree with it. I received from Joe Pimbley, who said that success in credit is not correlating with quality of risk assessment, data availability, qualification of credit analysts, and everything of that. The only the only thing success in credit correlates with is actually knowledge of a creditor of its customers or its obligor's business. The better you know the
100% agree.
the better you know the business, it irrespectively financial statements, ratios, and so on and so forth. You need to understand the business, how they take decision. You need to know their business model and even model for them, like not really analysis of customer financials but modeling them, just to understand just to understand the way they do business. The better you understand it, the better decisions you take.
And I'll tell you one thing that for me is always the critical part of analysis.
Yeah.
When you do credit decision or when you do any type of due diligence, is I need to understand how business working, what are the numbers produced on this business, and how this business can produce these numbers. If
Yeah.
I have a gap between the two, if I understand the business is doing X, Y, Z, and the numbers are not something I can explain out of X, Y, Z, that's to me an absolutely alarm bell. It's just telling to me, okay, with what people explain me about how their business working, these numbers cannot be produced. So maybe it's a fraud. Maybe they do some other parts of a business I'm not aware of. Maybe there are other things, but whatever it is, unless I understand and can link the two, I don't believe in the numbers. If I understand that this business can produce these numbers, then okay, then I believe the numbers, and then I can do all the different good things that you do analyzing the numbers. But if I don't see these numbers coming from this business, it's a problem.
Well, but you can always ask for explanation and listen.
Exactly. And
What
and that's why I'm
explanation
saying
they
you
will
drive until
provide?
you.
What explanation they will provide, and you by explanation you can see what it is. So we got very good thing, by the way. Uh, Another question from Nomer. Or at least it is. I'm sorry if I pronounce names incorrectly. I didn't intend to do that. If partner have good payment behavior through past years, but if we review the latest financial statements for company and we found so in bad financial position, so he should we continue provide same credit limit to customer, or we should withdrawal or reduce limit? May I start with answer, because my answer will be quite short. Um, well, payment behavior is not everything, because we don't know if they got simply access to finance, if it works or not. At the same time, well, it might take too long time, but what I'm trying to say, I had a customer who had Altman Z score below 1.5. And this customer was paying us, tens of millions of euros every month with no single day of delay. Again, as we just said above, together with Igor, we need to, there is no simple way, and I think this will be the worst thing you can do, is just to withdraw credit line or reduce the credit line just because you see the deterioration in customer financials. This is good reason to speak with them. This is good reason to ask questions and to clarify and to see the scenarios which might happen, and then together with sales, first of all, because great idea to share this data with sales department and decide what can we do. There are 1,000 different ways how we can structure the deal, even though financial statements are showing deterioration. Igor, what would you suggest in this case?
I mean, look, the first question you need to see is why. And by the way, if you have a good sort of communication with customer, you're not going to be surprised to see it. You would know well in advance, there is a problem
Yeah.
here and there. When you see it in the numbers, you just know what you already know and just see it in a number. So you really need to understand why and what's causing it, and how what is the way out, how people are managing, and then if indeed there is a reason to believe that company in itself cannot support amount of credit you need to do it. Of course, you need to adjust the credit, but the first thing you are looking, if they actually need it, is whether you can have some enhancements. That's a good topic to discuss, and maybe people can provide something that will make you more comfortable. So, like what I would not do, I would not go and mechanically, just change the credit. I will say, guys, we have a challenge, and we need to find a solution. What can we do together? And very often people can come with a solution. Maybe they can they have another strong company in the group, and they will just say we will provide a guarantee from another company because we are doing a reposition of the business between companies in our group. Nothing to do against you. It's just we need to include somebody else in our relationship as a guarantee agent and several whatever it is. For example, like I see tons of the stuff when sometimes people just do tax optimization. They, particular entities they use, they book less profit because they book profit in a different part of a group in a perfectly legitimate way, in compliance with all the laws, but, just they do it in a different way. Like if you look at majority of large, very, very credit-worthy multinationals, and if you look at a lot of the subsidiaries, you'll find some of the subsidiaries you would not touch with a stick as an own risk if you don't believe they are part there. And what you do there, if your exposure is really high and you are not sufficiently relying just on the name and ideas that they will not let their subsidiary down, you ask, okay, can you have a parent guarantee, for example? But you understand that the situation that you see in a particular company, nothing to do with real economics, it's just to do with the way business is organized within a group. And even in the private groups, you often see it. So you really need to understand, there may be a million of explanations. Until you know what it is, you don't know what the right solution.
Well, I just echo what Igor just said. That and I already said that above previously today, that credit risk, the worst thing you can do in majority of cases of credit management is when you simply link assessment of credit risk or estimation of credit worthiness to a credit decision. These are two different steps of the process. You analyze risk, then you take a decision, and decision should not be always driven by credit worthiness solely. One more question I received. Afan, I believe, please find a way to stop me if you send it directly to me, because it was said directly, but if you don't mind, I will simply read it so Igor can see it as well. One of my new customer made initial few payments on time and asked sales team for more credit based on payment history. On sales request, we had to enhance the credit as sales department was more dominating in company. Once credit limit enhanced, customer utilized it immediately and absconded. How frequently we should review customer credit limit? Igor, yeah, please.
Ideally, you need to do it constantly. And ideally, whenever you have any event or any piece of information that provides you a reason to look at this, you look at this, and you need to do it frequently. So, like particularly in a current environment, annual quarterly review is not sufficient. You just need to. But again, if the business is very boring and very stable and nothing happened and you see no reason, maybe it's enough. But in many businesses you need to look there. And with a new customer, you always need to look at a microscope, right? Because you don't know enough about them. You just need to learn. You go on a learning curve. Again, all depends from a volume. Like at the end of the day, you like in terms of the depth of the credit assessment, you also need to look at economics, because if your customer is buying from you $500 worth of something, and your margin is 10%, your budget for credit assessment cannot exceed $50, because that's the only money you're making on this customer. And if you cannot make assessment for $50, you don't need this customer, because you're not going to make any money, like if it's a single transaction. If you have a large relationship, large exposure, large margin, then you need to put a lot of effort, and you can afford it.
Well, Afan, I will say that what you faced is technically what is, I mean, one of the variation what is called quick fraud. So if customer left and disappeared in let's say after 3 or 4 transactions, just they got credit, then it's a question how do you have any capacities, just as Igor recently said that you need to understand what is behind this business, because it is quite simple. You can face it as soon as you grant credit. This is what is called case of fraud, and this is not long-term fraud where assets are taken out of a company. It's just a question of your credit assessment. Again, if you got one case like this and you've got 1,000 other profitable customers, you may afford it. I mean, if we compare the cost of analysis of 1,000 customers, could be high or small. It is always dependent on the specific circumstances. And my suggestion is to that would be 2 suggestions to you. First is to calculate comprehensive cost of servicing receivables, which would include normally analysis of customers or something like that. And then you will see how you can improve, because when you calculate it, we will have, by the way, masterclass this year on this. You can see what is better, secure receivables or simply afford certain level of bad debts based on your experience. On the but contrary, again, how often to review credit limit? Well, as much as it is required, but at least once a year you need to review. Your customers' financials, and you need to discuss that with sales. But what you mentioned, Afan, is just like if sales department is dominating in the company, well, good idea, and so they can what is called dictate decisions. Well, why don't they take responsibility for the bad debts as well, since they are dominating? Because to me here you got not problem even between credit and sales. Here there is a problem between power and responsibility. So the bigger the power, the more responsibility it should take. Yeah, for instance, good CEO simply knows that good CEO simply knows one thing, there is nothing in the company he or she is not responsible for. Yeah,
but I mean, I'll go back to 2 of the Andriy's points. One about fraud. Now, fraud management is completely separate, in my view, area from a credit management, and there is a whole bunch of tools and a whole bunch of things you do to prevent fraud, just going beyond the scope of this discussion. But yes, one thing I will say that is very important about fraud is fraud can go from 0 to a lot, almost instantaneously, because fraudsters are in a business of testing your defense. If they find you have a weak defense, you will suddenly get massive number of fraud. So people find it, for example, for small accounts, you don't make any checks related to, for example, identity of a company, yes, existence, whatever. You will suddenly get thousands of orders coming from, fraudsters at the same time. And if your systems are not designed to deal with this, then you will get like a massive problem. And contrary, if you start doing, like at some point we implemented a fraud management system that probably take care of about 70% of the attempts. The actual fraud reduced 100 times because fraudsters immediately found we are more difficult targets than our competitors and no longer want to target us. Even our defense was only for 70%. It just was like, you know, a door when you have an alarm on your house or something like it. You know, the burglar is looking there saying that's more risky, that's more difficult. There is a house next to you that is either a target, so I'm just going to the next one. So that's about fraud. About the power, again, you know, that's what I started discussion when we just started this one about, you know, credit policy as a form of a balancing the power, and that's a corporate decision there. Ideally, and I had clients when we actually make sales compensation dependent on cash collection, not dependent on sales, because sales is a theoretical number. You know, like let me just in a very simple account. In a very simple accounting term, what is the sales? It just move of an asset that is inventory to an asset named account receivable. So I have my goods, and I just have, instead of my goods that were lying in my warehouse, an account receivable. It's nothing. There is no economic substance to this transaction. The only economic substance will happen when receivable is collected. And therefore, to me, there is this conflict and there is this issue when people are measured exclusively on the fact you just reclassify the asset. You know, who cares? You know, until this is converted to cash,
yes,
nothing happens. There is no sale. There is just, you know, an account receivable. You know, it may be uncollectible, it may be fraud, it may be anything. And only at this point we can get. And there is this conflict, and the conflict exists that if the sales are measured at the point of transitioning from inventory to account receivable, this is disconnected from what the company needs. And sometimes you need to fix it.
Okay, Igor, we've got a question from Priscilla, which I feel, and I'm absolutely sure this is completely to you. Could we please tackle this issue? If a client has a high claims ratio and presents a debtor for trade that we are not willing to extend further cover on. So I presume this is the question from the credit insurer. Does a reduced insured percentage make credit better? In my experience, the security does not even make the credit better. Your input in this regard, please.
And the question is from insurer or from the company?
Well, that's unclear, but I got.
Whoever asks the question can put a mic on and ask the question verbally.
Yeah, Priscilla, please put your mic on and let's discuss it.
Very happy to answer.
Hi, this is from a credit insurance site. I am in a senior underwriter position, and I just wanted to understand if an insured percentage that is reduced from a debtor that we are not willing to extend further cover on, does it make this credit a better credit?
Okay. I don't think there is a clear link between the percentage insured and the risk, because your assumption there is that the supplier knows something you don't know. If this is the case, again, a little bit depends on the margin, how important is risk retention to them. If they're in a low margin business, doesn't really change much. If they're in a very high margin business and, you know, they're a bit irresponsible saying we are covered for 90%, our margin is 80, then you may actually look at this as some type of getting more incentive, providing that this is going to change somehow their decision. Most of the cases when I see insufficient cover, it's more about the dialogue. It's more about sharing information and can you. And I done it many times. When the underwriter is not able to make a decision, we say, okay, what information you need? What are your concerns? What do you want to find out? The percentage, it's some insurers trying to do it. I don't find it very constructive. Like most of the cases, typically wouldn't change the risk. The proper exchange of information would. Sometimes you can look for extra security, and what you do as an underwriter, you ask, for example, for guarantees within a group and things like it. But percentage itself, again, can be in some cases, but very rare.
Thank you so much. It really answered my question because I was in loggerhead with senior. Thank you.
Priscilla,
Okay.
thank you. And I just add, because I'm allowed to speak, I will simply add 2% into discussion. I just like the sentence which saying that company of $1 billion net worth and company of $1,000 net worth will have the same, may have the same probability of default. It's quite simple. Igor, you are becoming a star. I mean, actually, you are already a star. But there is a question from Paolo. What are the 3 best advices Igor would give to a credit professional nowadays? So your answer will conclude our today's event. So, ladies and gentlemen, listen carefully. So 3 best advices from your side. I won't even add something. Promise.
I mean, fundamentally, there are few. One related to using your brain. That often you need to use your brain, and you really need to think and understand what is behind the numbers, what is behind the business, and things like it. Because very often the temptation is to say, okay, I just follow certain template, and there are no ideal templates. The second part is stand your ground. Like you should not be allowed to be bullied, and you have various and I'm not saying this in terms that you are not working with people constructively. You just need to make sure that people are not seeing this as a power struggle, as the fact I'm in a sales and I can force you to do X, Y, Z. If you manage to get yourself to the stage when you are seen as a partner and as somebody with whom you need to deal with as opposed to you need to fight with, that's important. And the third, as I say, out of the 3, I say 2 will be related to soft skills. And the third, you need to build credibility with your customers. Again, you should not be viewed as an enemy. You should be looked as a partner by the customer. And that means there is an issue, they will help you, they will cooperate with you, they will provide you information, they will discuss with you, they will give you in confidence what you need to do, and you will be able to make the right decision. Because if you are not built in this credibility, then you have a problem. And that's 3 things I will suggest. If you follow them, you'll be very successful.
And trust me, this will happen. Ladies and gentlemen, thank you very much for coming to joining us, to come into our online event. I really thank Igor. Igor, thank you very much for finding time and sharing your experience. This is not the last time we have Igor, I promise, because I got personal touch with speaking with Igor. To me, it's always a great chance to speak with him. We will meet next month in Credit Chat or any other online event with Credit Engineering. For now, I wish everyone to have big sales, low losses, and if people would say that in French, bon crédit.